What happens when an economy grows without real strength? In the near term, headline GDP can accelerate, stock indexes can climb to fresh highs, and household balance sheet snapshots can sparkle with nominal wealth. But growth recorded by accountants is not the same as capacity created on the ground. When the machinery that keeps prosperity turning, productivity, saving, and high-yield investment, slows even as reported output rises, the result is a facade, an expansion propped up by leverage, policy subsidy, and asset inflation. Over the past decade, several of the world's richest economies have assembled that facade with striking consistency. They borrowed at historically low interest rates, recycled the funds into consumption and share repurchases, and booked the immediate spending as progress. The surface indicators looked healthy. Underneath, however, the bedrock meant to hold future living standards steady eroded quarter by quarter. To understand how that erosion happens, and why it matters, one must examine the balance sheets that financed the boom, the markets that rewarded it, and the demographic currents that now threaten to expose it. The clearest sign of the mismatch is debt. By March 2025, the combined obligations of governments, businesses, and households reached roughly $324 trillion, about 3 times world output and $7.5 trillion more than only 1 quarter earlier. The increase was led not by emerging markets but by the United States, France, and Germany, mature economies whose bonds still trade as safe collateral. Cheap funding did not arrive by accident. A decade of quantitative easing, followed by emergency pandemic liquidity, anchored sovereign yields far below historic norms and flooded the financial system with reserves. As soon as central banks hinted that borrowing would remain inexpensive, fiscal authorities treated the signal as permission to run larger deficits, while companies and households leveraged up in parallel. Debt itself is not fatal, yet debt that grows faster than the income needed to service it creates fragility. At the current trajectory, a 2 percentage point rise in developed economy funding costs would require hundreds of billions of additional interest expense each year, resources diverted from investment to mere maintenance. Corporate behavior reinforces the pattern. In the first quarter of 2025, publicly listed American firms spent almost $294 billion repurchasing their own shares, a quarterly record that pushed the trailing 12-month total near the $1 trillion mark. Buybacks shrink the share count, inflate earnings per share, and boost executive compensation metrics, but they do not expand productive capacity. Factories are not upgraded, laboratories are not built, and employee skills are not deepened. Instead, cash returns to shareholders, who often recycle it into the same equity market. Across the Atlantic, European blue chips issued cheap 10-year paper to fund dividends rather than research, exploiting negative real rates while they lasted. In effect, financial engineering substituted for industrial investment. During a boom, such tactics appear harmless, profitability looks strong and valuations climb. Yet when credit conditions tighten, firms discover they own fewer hard assets than their balance sheets implied, leaving them with leverage but without the revenue streams that would have justified it. Households adopted the same logic. In the United States, the personal saving rate averaged only about 4.5% through spring 2025, barely half its post-war norm. Consumers were comfortable spending because rising home prices and booming retirement accounts made them feel wealthier, a classic wealth effect. At the same time, they borrowed freely. Credit card balances, auto loans, and adjustable-rate mortgages all climbed as lenders chased volume in a low-rate environment. Across the Pacific, South Korean families carried liabilities equal to roughly 92% of national income, the second highest ratio among advanced economies. Such leverage keeps consumption humming, yet it also ties household cash flow to the dance of monetary policy. A single percentage point rise in mortgage benchmarks now siphons billions of dollars from discretionary spending, with immediate knock-on effects for retail employment and services output. Put differently, yesterday's cheap debt converts directly into today's macro sensitivity. Housing markets transform leverage into visible wealth. Germany provides a vivid example. Only 42% of Germans own their homes, yet prices in major cities rose more than 50% in the past decade. Low mortgage costs kept monthly payments manageable for incumbent owners, but deposit requirements soared for new entrants, pushing the median first purchase age above 40. As a result, real estate equity concentrated among older cohorts while younger households remained tenants, funneling a rising share of income to landlords. Home price appreciation therefore registers in GDP via imputed rents and construction activity, even though the underlying outcome, limited access to ownership, signals weaker social mobility. If rates climb sharply, price-to-income ratios will have to adjust downward, wiping out collateral that supports both household borrowing and small bank balance sheets. Apparent growth thus coexists with latent vulnerability, its scale dictated by how far valuations have outrun wage fundamentals. The health of an economy ultimately rests on productivity, and here the data paint a flat picture. The OECD estimates that output per hour worked across its members averaged roughly $67 in 2022, barely higher than 5 years earlier and below the trajectory needed to offset aging demographics. Technologies such as artificial intelligence, advanced robotics, and cloud computing promise efficiency, yet diffusion outside a handful of frontier firms has been slow. Many businesses use cheap credit to acquire competitors rather than upgrade capital stock, a choice that boosts market share without lifting aggregate output. When GDP grows faster than productivity, the gap must be filled by longer hours or greater leverage. Both are finite. Longer hours encounter human limits. Leverage meets the boundary set by lenders' risk tolerance. A productivity shortfall therefore acts like gravity on living standards. It may be ignored for a few years, but it never disappears. Public accounts reflect similar strains. Japan's central government debt hovers near 216% of GDP, a level once considered inconceivable. Servicing costs remain modest because the Bank of Japan keeps 10-year yields close to zero, but even a moderate UPTICK would swell interest outlays and crowd out social spending. In Europe, debate about new fiscal rules recognizes the same tension. Governments must invest in security, energy transition, and healthcare, yet the debt ratios already eclipse targets inherited from the 1990s. Every additional borrowing program flatters current year demand while shifting repayment obligations onto future taxpayers, who will inherit slower population growth and smaller workforces. If markets start to question the guarantee of low yields, rollover risk could turn what looks like a stable liability into a crisis catalyst. Price stability, long assumed in advanced economies, has also proven fragile. Core inflation in the euro area fell from 5.7% in March 2023 to about 3% a year later, yet services inflation stayed stubbornly high. Wage contracts now embed expectations of larger annual increases, and firms pass cost pressures along supply chains that remain brittle after the pandemic. Central banks therefore face a double bind. Tightening too quickly could destabilize debt-laden households and firms, but easing too fast would risk a second inflation wave. Because balance sheets are levered to past interest rate promises, even talk of policy shifts can reverberate through mortgage rates, equity valuations, and sovereign spreads within days. Growth that depends on predictable money is least prepared for volatility in its price. Demography sharpens each stress point. The OECD projects that full career average earners will receive pensions equal to roughly 61% of final pay across the membership, but future replacement rates fall below 40% in a cluster of aging countries that already carry high household debt. When the share of citizens over 65 rises each year, governments must direct a larger slice of revenue toward healthcare and income support. That leaves fewer funds for education, digital infrastructure, or climate adaptation, investments that would raise productivity and offset aging. Households, sensing the gap, save more precisely when macro policy urges them to spend, undermining stimulus and lifting the debt burden further. In this way, demographics act not simply as a background trend but as an amplifier of fragility. Energy supplies bring a physical dimension to the imbalance. Europe's rapid pivot away from Russian pipeline gas after 2022 required record purchases of liquefied natural gas at prices several times the long-term average. Governments absorbed much of the cost through subsidies and price caps, keeping household consumption afloat but expanding fiscal deficits and locking in higher baseline energy costs. At the same time, the continent must find trillions of euros to decarbonize power grids, electrify transport, and insulate buildings. If borrowing costs rise before returns on those investments materialize, the transition could itself become a drag on growth, compounding rather than curing structural weakness. Supply chains offer a second physical bottleneck. German automakers and Japanese electronics giants entered 2025 still scrambling for semiconductors after pandemic-era shortages. Factories reduced shifts or paid premiums for scarce chips, and while GDP measured the extra spending, actual unit output lagged. To secure future supplies, governments are underwriting domestic fabrication plants, effectively replacing private investment with public guarantees. That strategy carries geopolitical benefits but entrenches the broader pattern. Borrowing and subsidy stand in for efficiency gains. Financial plumbing multiplies the danger. Between 2019 and 2023, Canada's share of new mortgages priced at floating rates rose from less than 20% to roughly half. When the Bank of Canada lifted policy rates 4 full percentage points, debt service ratios for affected households reached record highs within 6 quarters. Banks responded by tightening lending standards, bluntly reversing the mechanism that had turbocharged consumption. The episode illustrates how a headline shift in